Hi, morning everyone. Welcome back to Money Cup 88. Good to see you guys again. Aiman here. Right, so looking at the S&P 500, well, it closed slightly lower on Monday session, pulling back about 0.24%, but still holding above this 7,100 level. So overall sentiment remains positive, but we are seeing some consolidation after recent strong rally, right? And the pullback was mainly due to the renewed geopolitical concern with the uncertainty around the Strait of Hormuz, which raised the market concern. Also, at the same time, this move also reflect the profit taking after the recent rally record high, with the market taking a breather following the strong run in the past few sessions. But the downside was limited as the strong earnings expectation continue to support the market as we are entering into the earnings season forward. Right. So looking ahead, the market is expected to remain positive, holding above the 7,100 level. Again, support will come from the earnings momentum, but sentiment will still be sensitive to the geopolitical headline and also the oil price movement. Right, so looking at the US trading stocks that we have published yesterday, we got Tesla, stock code TSLA. Right, so the stock is experiencing a breakout at $400 level, and now we can expect the stock to travel towards the $450 level on a strong momentum, followed by the next resistance at $500 level. Now, if the counter to reverse, do watch out for the $350 level for the immediate support, as this could indicate an initial trend reversal signal together with the breach of the 21-day moving average. Also, next we have Broadcom, stock code AVGO. So if you look at charts now, the stock or the counter charted a high market structure, forming a high low formation to test to reach above the $385 level. So if the stock to climb up higher, we could see that it might travel towards the $420 level, followed by $450 level for the second resistance. So now if the stock to slide lower below this $360 level, this might signal to a bearish structure. So we have two breakout stocks for US, which is Tesla and also Broadcom. And looking at the China A50 futures, well, closed slightly higher on yesterday's session, but still trading below this 15,500 resistance level. So, as the key sentiment is mildly positive, but the market is still lacking a strong momentum for the breakout. So the upside was mainly supported by the bargain hunting as investors slowly returned after the recent volatility. So if you look at the broader picture, right? So we're seeing some improvement in risk sentiment following the mixed development in the global global picture. However, gains were limited as well as investors remain cautious on the China economic outlook with the ongoing concern over the growth, and also the demand is still capping the upside here. So looking at the technical structure, right? The market is still struggling to break above this 15,500 resistance level, which keeping traders in wait and see mode to wait for the breakout before taking any further actions. Right, so if you look at the WTI crude oil futures, where it closed slightly higher on Monday session, But despite the uptake, I think the overall tone remains cautious, and also we shift our positive trading bias to a negative trading bias after it hits our stop loss yesterday. Uh, Also, the upside was mainly driven by the renewed tension over the weekend after fresh escalation of the war, right, which raised concern over the global oil supply disruption. And also, this initially push the oil price higher as the market price in the supply risk for uh, I mean from the key global shipping route, right? However, despite the rebound yesterday, the market is still showing us a sign of instability from yesterday's move. So overall, price action is still headline driven, right? And also volatile with a clear sustained bullish trend. So looking ahead, I think oil prices are expected to remain volatile and with slight downside bias. So technical wise, for those of you who trade these futures, bear in mind that the recent move have reached the previous support level somewhere around 88 dollar level dollar level. So looking at the Malaysia market, our local market, the KLCI closed higher yesterday, gaining about 0.42% to close at uh, 17.30 points, breaking back the 1007 key level, while the FKR moved higher in line with the KLCI market index. So overall, sentiment improved slightly. But still cautious underneath. And looking at I think for this KLCI, right, the upside was mainly supported by the buy interest as investors rotated into safer names, and some of the investors are looking at the small cap names as well. So I think sentiment was also lifted by the stronger Malaysia trade data, which showed solid growth. However, despite the index closing higher, I think the overall breadth is still weak. Investors remain cautious. That limits the stronger upside breakout. So looking ahead, a higher rebound can be seen if the bullish momentum to persist. Right. So if you see here the heat map of our Malaysia market, well, the market was driven mainly by strong gains in banking heavyweights such as Maybank, CIMB, right, which lifted the overall market right right now. The upside was also further supported by interest in tech names like Inery. We have here uh, Zetrix, right? Although losses in some uh, plantation and also transportation counters kept the broader gains. So looking at the day-to-day sector performance, tech and also financial sector garnered attention yesterday, with tech was higher by 1.2% and finance was up by 1% yesterday, right? So moving to our Malaysia trading stocks, we have Inari and Mertron today. So the stock is on its breakout formation, higher at 1.75 cent level, right, on a strong volume. So with that, we expect the momentum to keep bullish and the stock able to propel higher to test the next resistance at 1.90 cent, followed by 2.05 level. So if the stock to clear the 1.60 support, this could reverse the course and trend lower. And next we have Syntax. So the stock is experiencing a breakout at 3.56 cent level. So if the stock to remains bullish, we expect for the price to reach 3.77 cent coming session together with high volume. Second resistance is at 3.98 cent level. So do keep an eye at the 3.35 cent level for any attempt of reversal. Again, we have two US breakout stocks and two Malaysia breakout stocks, which is Inari and also Sintex. So looking at the FCPO, well, it closed slightly higher yesterday, extending a mild rebound after recent weakness with some stabilization seen in the prices. So the upside was mainly supported by the bargain hunting as price recover after the earlier pullback and held above this 4,400 ringgit level, where buyers started to come back into the market. Yeah, there is still underlying support from the firm crude oil prices, which continue to support the palm oil. Though the biofuel linkage helping the FCO prices uh, to keep above this support level. So, however, gains remain limited as the market is still facing mixed fundamentals, including the expectation of improving production and also cautious demand outlook. And moving forward, we expect the FCPO, to trade in a positive sentiment, rebounding higher from this support level of 4,400 level. And we are eyeing for the 4,800 level for the first resistance. Second resistance is at 4,925 level. We maintain our stop loss at 4,400 level, right? So, yeah, that's all from me. And I pass it on to the next presenter. Thanks, everyone, and happy trading.
Yep. Thanks, Aiman. Good morning, everyone. So this morning we have a note on CIMB. This is the usual pre-close period meeting that they will have with the sell-side analysts before the results. For the upcoming first quarter results towards the end of May, our estimate is that the pre-impairment operating profit could be flat year on year, but up by about mid-single digit Q on Q. And non-interest income should be the key driver for operating income, whereas headwinds would be in the form of a weaker rupiah, plus also some NIM pressure. Couple of points to highlight. Firstly, on this Middle East conflict, CIMB said that the direct exposure is very minimal, and there wasn't any impact to growth or asset quality in the first quarter. Looking ahead, they said the visibility from second and third order effects is very low because there are all kinds of scenarios that could unfold. So they're not able to give too much color at this moment. By geography, in Thailand, they are concerned about the country's high energy intensity there, and they think commercial banking could be the segment at risk. But this is a segment which they have already exited a couple of years back. In Indonesia, it's also similar. The commercial banking segment is going to be the one at risk, they think. But this is a segment which has been undergoing a de-risking under the previous F23 plus plan. And they've also been very selective in terms of growth there. In Malaysia, the risk segments are going to be the SME as also the mass market. But the corporate as well as the other parts of the retail book, they think should be quite stable. For now, they haven't made any overlay top-ups yet. And given that there's very little visibility on the second and third order impact. And looking ahead, they did say that if any overlay top-ups were required, they can reallocate some of these US tariff overlays that they made last year to help cushion the impact on P&L. On the non-interest income side, as mentioned, this has been a good quarter for them. They pointed to trading as well as FX, where across the group, it was a very healthy quarter. The wealth business also was good. High-end segment, banca in Singapore, as well as fixed income products in Thailand, all momentum was pretty solid. On margin, there's going to be some pressure sequentially. You're going to have yield headwinds in Indonesia because of competition, as well as lower benchmark rates. But on the flip side, liquidity generally around the region has been quite ample. As such, CIMB has managed to lower its campaign as well as board deposit rates locally. In Indonesia, Singapore, sorry, it has actually released some of its costlier deposits. Focus is still very much on liquidity, and that's going to drive the asset growth for 5 to 7% target for this year. All in, no change to our earnings forecast. Our target price of 9 ringgit and our buy call are also unchanged. Our buy call is premised, on CIMB's strong and liquid balance sheet. Loan loss coverage, 100% plus, is one of the better ones among peers, and valuations also look attractive given that the stock is a laggard. Including the capital return dividends, we estimate dividend yields of about 6.5% to 7% for this year as well as next year. Okay, so I'll just pause here and pass you to Jeff.
Okay, thanks, David. We have a telecom sector update. This is part of the second quarter strategy that we've just released. Now, if you look at the sector as a whole, no change there in terms of our rating. It's still neutral. There's been a wee bit of interest in recent months. Obviously, safe harbor sort of the sector. The investors are basically, fixated in terms of the domestic-centric earnings profile. And if you look at the dividend yields, on average, the sector gives out about 4%, so not too shabby there. If you look at sector valuation, it's a near 2SD of its historical mean, EV/EBITDA mean. This is basically fair considering the overhang still from the 5G and DNB side of things, as well as competition. Exposure-wise, we still continue to like the fixed integrated players, given their stronger growth prospects, as well as structural catalyst. Now, if you look at 2026 in particular, just based on guidance from the MNOs, they're looking at tepid growth, low single-digit trajectory. EBIT-wise, they are basically saying that it should basically track top-line development. So there are some cost savings there, obviously, and I think most of the low-hanging fruits in terms of cost have been plucked. So going forward, it's a little bit of maneuvering in the revenue upside as well as cost. Competition is still fairly tight, continued pressure in terms of data yields. And, having said that, I think if you've been monitoring the prices of prepaid and postpaid plans in recent months, there's been a slight upward repricing in terms of postpaid. I think competition in terms of prepaid continues to be fairly intense. In terms of the fiber broadband segment, I think, last year you see, hyper competition there as most of the MNOs, were upselling fiber broadband plans to their mobile base. This year to date, I think competition has tapered off a little bit, but still fairly intense in terms of price points. We do expect the fiber broadband and wholesale segments to remain a key growth driver, especially for the fixed line players. For TM specifically, they should be booking higher domestic fiber backhaul revenues. U Mobile has basically just turned on their 5G network, and you should see a lot of contributions coming from the access-seeking component for TM's business. In terms of dividends, I think this will continue to be a narrative for the sector, particularly the fixed players, TM and Time.com. If you look at the balance sheets, both are significantly under leverage. Specifically, if you look at Time's net debt to EBITDA target, they're looking at 1 to 1.5 times over the next 2 years. Currently, balance sheet is in a net cash position, so a lot more room for upside surprises in terms of dividends. Just about a quarter ago, they've revised their dividend payout policy to 50 to 75% on normalized earnings. It was up to 50% previously. TM record high dividend payout ratio last year, 69%, which is really ahead of their old DPR policy of between 40 to 60%. We believe that they may be announcing a new dividend policy soon, potentially during its first quarter results in May. Our recent conversation with TM suggests that they may want to actually fund dividend payouts from internally generated cash. which they do have, and they'll gear up their balance sheet to basically finance capex going forward. Now, in terms of developments with regards to DNB, the three telcos, the likes of Maxis, CelcomDigi, and YTL, they paid about 328 million to the Ministry of Finance as part of the put option exercise. The telcos, in particular, two Maxis and CDB, have yet to actually, book in the losses from DNB. They need to actually reflect the equity share. They've not done this pending the fulfillment of certain conditions precedent. We don't expect this to be fulfilled by the first half, so it's probably going to be a second half story in terms of equity accounting. Now, we have previously estimated the impact in terms of both Maxis and CDB's numbers to be between 7 to 9% in terms of FY26 core earnings from the impact. CelcomDigi's management had previously said that they are projecting an impact of about less than 5% to the FY26 numbers, assuming that the recognition comes in from the second half of the year. Obviously, telcos have done a fair bit trying to streamline the cost over at DNB. FY22 and 23, you've seen mounting losses of about 1.2 billion. I believe that number has actually come off quite significantly over the past 12 months or so. I think the other issue to note is really TM has been trying to get themselves out of the 5G wholesale agreement with DNB. Both parties are basically at loggerheads now. I think DNB is saying that they still need to honor their 10-year agreement. TM feels that based on the provisions within the previous access agreement, they can basically exit that agreement and terminate that whole structure in itself. So it's really up to probably some legal opinions as to how they want to proceed with that 5G access agreement. Our base case here is for TM to continue, obviously, wholesale agreement until 2032, which is a 10-year agreement. In a worst case scenario, this is also probably will be the worst case. As you know, DNB is basically interpreting that the agreement remains binding. Best case, TM gets to exit from DNB by year end. I think this is what they are gunning for, and that's the reason why they actually signed that MOCN, the multi-operator core network deal with U-Mobile. Now, if you look at that MOCN deal in itself, it actually makes sense for TM because they do have a much smaller 5G base relative to their competitors, Maxis and CelcomDigi. And just by moving out onto the MOCN network, U-Mobile, they do actually save quite a fair bit in terms of wholesale and direct costs as a whole going forward. So overall, just to recap, we're maintaining our neutral core in terms of the sector. Our preferred pick, no change there. We still like the fixed integrated players, and for that, Telecom Malaysia is our preferred pick. Okay, stop here for now, and I think that's probably all for Morning Cover today. We'll see you again tomorrow. Thank you.